Hey everyone. I hope you're having a great evening today. Welcome to our session where we're going to cover how you can actually bag something from this market. And we'll be looking at stochastics and how you can use combined with another indicator called a moving average to find some opportunities in the market. So with me here is my colleague Edwin. As always, Edwin, you can say hi.
Good evening, everyone. Welcome to our first session of decoding the charts.
Okay, all right. And let's just dive into it. Be looking at 100 EMA and moving averages. So move us to the next slide, Edwin. Okay, so what are the objectives of this session? We want to look at moving averages and a stochastic oscillator. I want to look at how can you identify price behavior using these two indicators, and how can you even apply these two indicators to find trade setups. And of course, Edwin will take us to the examples that we can look at in the markets. Before we move next, I would want to say we've just selected just two indicators today. There are so many indicators that we can use in these markets, so many tools. But I want to mention that when you're forming a trading strategy, because today we'll be moving straight to a trading strategy using the stochastic and EMA. When you're forming a trading strategy, you find a tool that is going to help you understand the markets. And once you understand the markets using that tool, that is when you form rules based on the same tool, right? So a trading strategy is basically like rules that you form, and you have check boxes or tick boxes based on those indicators or the tools. That's what I'm calling tools. So let's look at what a stochastic, what a moving average is. So it's just an indicator that smooths out the price movements. Okay, it's an indicator that is calculated based on the average closing prices, okay, of the candlesticks. And you can choose the number of candlesticks that you would want to have. If you have many candlesticks, then you have a very slow moving average. Okay. If you choose very few candlesticks, you have a fast moving average. So in our case today, we'll be using a single moving average, and with like 100, taking into account 100 candlesticks or 100 periods in this case. So traders want to understand the direction of the market, because what you want first is to understand the flow of the market. Once you understand the flow of the market, then you have quite some level of leverage in the market already, because you understand where the trades will be in favor. Yeah, for example, if it's an uptrend, you're more likely to find trades which are in favor when you're buying, right? If you're on a downtrend, you're likely to find trades which are in favor to the downward move, which is going short. So a moving average, of course, reduces the noise in the market, because when you look at the charts, you see the candlesticks going up, down, and without having that charting tool, might be difficult to trace the flow of the market. So a moving average smooths out or reduces that noise, and it's very important. So a trader can typically get, is it a downward move? Is it an upward move? Okay, and based on that, then you're able to pick out or speculate on the likely direction of the market. Of course, moving averages are more effective if the price is in a trend. So when you're using a moving average, this is for traders who are looking to flow with the trend or ride the trend. Okay, and we want to look at how you can check out on that. So in our next slide, we want to discuss on the stochastic oscillator. Well, a stochastic oscillator, again, is another indicator which is based on support and resistance, and it checks the ranges, whereby if you look at the highest range and the lowest range, how was the price averaged out? Okay, and of course, it is calculated based on a formula that we can't really dive deep into it. We have got the percentage K, percentage D, And one of the percentage G is basically smoothing out the percentage K, where it's just checking that formula of the percentage K is checking out whether the prices are closing near to the highest of the range or closing near to the lowest of the range, which is used, of course, to know whether there is some disparity in the price movements, and therein traders use that one to get in or find some opportunities in the market. So, of course, just to make matters simple, you're using an oscillator, which is a two-line. It's a two-line indicator. Using that oscillator to show you overbought zones. When we talk about overbought, is where to understand it simply, there has been a lot of buying in the market. Prices has been rising and rising. Buyers have been strong, right? Or buyers have been trying to push the price up. So there's been a lot of buying, and that indicator, as we will see on the charts, of course, Edwin will take us to the charts. When it's above a certain level, then you're able to know that there's been a lot of buying. But beyond that level, of course, the prices are so high that they are no longer attractive, right? So you note that there's a likely reversal. That's what we'll be combining together with what we can see on the moving average, or even a resistant line to get opportunities. On the oversold, because again, you use it to get oversold levels. This is where you have the prices. You understand that there's been a lot of selling. Prices has been pushing down, right? And up to that level, they have gone so low that the incentive to sell is not as high in the market. And that's when it's an opportunity again, because if the traders have not been able to push the price lower beyond a certain level that you can see on the moving average, then it can be a switching point to go to the upside. That's what you're looking for, and exploit that opportunity. So today, maybe before you go to the next session on the charts or how the strategy looks like, you need to know that a stochastic is just an oscillator. It's oscillating between two levels, right? The lowest one is 0, the highest one is 100, right? So you want to see near the lowest level is where you have the overbought, especially at 20. Sorry. Near the lowest level is where you want to have the oversold. Has been a lot of selling. Near the top is where you're going to have the overbought. So oversold at the bottom is where you have the level 20, what you consider most. And at the top, we look at the level 80. So with that short introduction, Edwin, maybe you can take us to the charts, and let's see how things look like, how you can apply the trading strategy there.
All right, so I'll pick it from here. So basically,
sure,
as Mathew was trying to explain, we're just trying to look for scenarios where stars are stuck in our favor. You want to have several or multiple indications or signals or triggers, whereby once those triggers have occurred back to back, then you know that you have an edge in the market. So we are trying to increase our probability to get scenarios where we would be able to predict with a significant level of certainty where price will move towards. So in this case, we have our moving average. So we are using 100 period exponential moving average. And as you will notice, when you have a very strong trend, not only will you be able to know the direction, because one of the things that you need to know as you trade, knowing the direction of the price long-term will give you a leverage, because ideally you're meant to align your decisions with the long-term direction of the price. So aligning your trades in line with the direction, you're already halfway towards identifying the right opportunity. So in this case, you can clearly see that price is trending higher and higher. And as Mathew was trying to explain, once you add a moving average, so in our case, we are using 100 period exponential moving average. For the most part, you will notice that the price action will be more concentrated above that moving average. So price will be rising and falling and sort of bouncing off that moving average. So ideally, you're trying to wait for scenarios where you'd have pullbacks in price. And once price gets back to the moving average, then you're waiting to have price initiating a reversal. So in this case, since the market is trending upwards, not only will we be able to know the direction, but also this moving average will sort of serve as a dynamic support zone. So when price comes close to 100 period exponential moving average, ideally we'll be able to know that within that zone, we can get a support zone. So yeah, so that is how we are using this moving average. Then we are combining the action on the price with the indication on stochastic. So with stochastic, we are trying to look for scenarios where you'd have these two lines. So the blue and the red line that are moving up and down, these are the lines that Mathew was referring to. So we have K and D. So basically, the flow of stochastic sort of tries to mimic the flow of the price. So it ranges between 0 to 100, and we have two zones. So when the price is on the lower extreme, at a level below 20, and the more closer it is towards the lower extreme, so the more these two lines are way below level 20, or when they are close to 0, then it means that price has, or the state of that asset is likely to be in an oversold state. So it means that prior to that, most traders were participating in selling. And given that at that point in time, most of the selling activity will have ended, then you'd wait to have this indicator reversing upwards in an oversold zone in order for you to know that there might be an opportunity to buy. So given that now we are trying to combine the trend, the overall direction of price, in order to know when the price is oversold, ideally these setups will give you a scenario where price is just about to embark and to continue with the prevailing trend. So from what you can see on the chart, you will notice that these are scenarios where you may get into the trade and have price shooting upwards. So you're sort of continuing with the prevailing trend. Again here, price makes a pullback. Then once it begins to reverse upwards, you're confirming whether indeed that is a viable setup based on the action on stochastic. So stochastic should be indicating to you a scenario where price was in an oversold zone, and the reversal of the two lines then would indicate a possibility of price embarking on the prevailing trend. Again, this is the last setup. We have a pullback in price. Then, as you can see from the stochastic oscillator, it's indicating to us that at that point in time, most traders were participating in selling. And given that we were in an oversold zone, as can be seen on stochastic, then having price pulling upwards along 100 EMA would give you a setup to buy, because the trend is highly likely to continue upwards. So these are just but a few examples of buy setups or scenarios where you could enter buy positions. Then for sell setups, the opposite is true. You'd want to confirm the prevailing trend. So as much as possible, when price is trending lower, when the long-term direction of the price is to the downside, it would make sense for you as a trader to try and get sell setups. So using these two indicators, you'd want to have price pullbacks close to 100 EMA. Then when price initiates a bounce or a reversal close to 100 EMA, you'd check whether the stochastic is sort of giving you a confirmation. So the confirmation would be to have these two lines of stochastic oscillator having risen above the 80 level. So between 80 and 100, that would be an indication that the price is way in an overbought state. So as those two lines begin to reverse downwards, and if that is converging with a case in point where price has made a pullback close to 100 EMA, then it initiates a reversal to the downside. Once those two actions coincide, then that would mean that there's a high probability that price would embark on the prevailing trend. So price would make an impulse move to the downside. So this two would give you the first setup along this strong downtrend. Then here is another setup. So price makes a pullback, then it initiates a reversal. And a reversal would obviously be a case where price would begin to form bearish candlesticks. Then you'd confirm whether at that point in time price is in an overbought state. And that would be by virtue of having these two lines of stochastic having risen above level 80 and initiating a reversal within that zone, so between 80 and 100. So here you have another confirmation, and again you'd get that impulse move to the downside. Then here we have the third setup, then this confirmation on the basis of stochastic, then price made an impulse move to the downside. And lastly, here's another setup. So you have price making a pullback close to 100 EMA. It initiates a reversal to the downside. And at the same time, it so happens that stochastic is giving you a confirmation of an overbought price. So those setups are sell setups, or that is the kind of picture or the kind of context that you'd want to have on your charts. And here we are dealing with a 4-hourly time frame chart. Then when it comes to stop loss, you're using one ATR. So ATR is an indicator that shows the average range in terms of price movement based on the last 14 candlesticks on the chart. So when you add ATR on your chart, you'd be able to see by how many pips is the price moving on average based on the last, or based on the movement of the last 14 candlesticks on the chart. Then take profit. You can determine the take profit by taking the number of pips for stop loss, and you can multiply them by 1.618 Fibonacci, or you can multiply that by 2. So a risk reward of 1:2, basing it on ATR, or you can as well use the most recent support level in a case where you're looking to take a sell position, or if it is a buy setup, you can base your take profit level based on the most recent resistance zone. Then we'll now dive into the charts to have a look at a few examples that have happened in the recent past. So in the recent past, we've had very nice setups on 3 charts, or at least I was able to identify 3 trade setups on 3 pairs. So the first one was on Aussie Swiss franc. So if you look at Aussie Swiss franc, from 21st of January, it has progressively been on an upward move. So here we could actually draw a trend line and connect multiple touch points along this trend line. So we have multiple price touch points along this ascending trend line. So this trend line is sort of confirming to us where price is headed. So we are on an uptrend. So generally within this chart or within this context, we would be looking for a buy setup. Then we have added our 100 EMA and stochastic. Then in this particular case, we would wait for the price to make a pullback downwards. And when the price comes close to 100 EMA, or when price is hovering close to 100 EMA, we are waiting for initiation of an impulse move to the upside. So once price begins to reverse upwards, then we would check whether stochastic is giving us a confirmation of an oversold market. Then when we get that confirmation, then we would want to enter our buy position. So in this case, as you will notice, when the market began to reverse, so the red candlesticks are bearish, blue candlesticks are bullish. So when the market began to form bullish candlesticks, and having gotten confirmation on the basis of the behavior of stochastic oscillator, then here you could get into a buy setup and you'd be able to get anything between 0 pips up to around 98 pips. So my entry was at 0.6593, and my exit was around 0.6631. So that was a total of 38 pips. And if you had traded a mini, so if you had traded a mini lot, you could have gotten around, let's see.
And by the way, as you're looking for the specific trade, just would like to remind the traders that you can get the position size calculator on the FX Placer platform. Just log in there, and just before placing your trade, you can always understand what risk am I in, what's the potential profits that I'm looking at. It can always be very convenient, especially when it comes to risk management and understanding the expectation.
Yeah, precisely, Mathew.
Yeah,
it's important to know the risk that you're taking in comparison to the amount that you're targeting to make.
Yeah, exactly. And by the way, as you're looking for it, I think I would like us also to look into, although it's something for another day, but just want to note, at that point where you're getting that trade, I see someone can as well look at the candlestick patterns happening around there.
Yes. In fact, one of the setups is a case where we have an additional confluence of a rejection candle. So
rejection candlesticks.
Yeah, ideally you're trying to look as many signals or many triggers as possible. So the more triggers you have, the stronger the probability. The setup. Yeah, the higher the probability would be.
Exactly.
So so this is a trade setup. It was an entry, so it was sometimes late in Feb. So it was a buy setup, a mini. So if you had traded a mini, that 8 pips would have yielded around $41 or so. Another setup was on Kiwi, Swiss franc. Again, this is another buy setup. As you can see, we already have a trend line. So from this point, from early February, this asset initiated an uptrend. So price was rising and falling. And it's a structure where you could actually connect these 3 touch points. We have 4 touch points. The first one, the second one, then the point at which price was coming to retest that trend line to have us confirm that indeed this is a support zone. Having had 100 EMA on the chart as well, you'd notice that when price came close to 100 EMA and our setup being enhanced by the fact that we had already drawn an ascending trend line, so you could tell that this is a support zone. So this zone is a support zone. Then going further ahead to check the action on stochastic oscillator, you can clearly see that stochastic was indicating to us that price was in an oversold state. So when those 2 lines, when K and D began to rise, as well as price reversing along 100 EMA to the upside, then it was an indication of the trend coming back to effect. So you could enter a buy position, and this setup could have given you anything between 0 pips up to around 120 pips. So depending on how you'd manage that setup, then you'd get anything between 0 up to around 120 pips. So my entry was at 0.6137. I made an exit at 0.6187. So those were around 50 pips. So if you had traded a mini on this setup, let me see. So this is the trade. So it was an entry at 0.6137, exit at 0.6887. So 50 pips could have yielded around $55 for a mini. Lastly, we have our only sell setup. So again here, not only do you have a structure where you could draw a descending trend line to mark your resistance zone, but having also added 100 period EMA, you'd wait for the price to make a pullback. So when the price made this pullback close to 100 EMA, then we knew we are along a resistance zone. Over and above that, as Mathew, you were trying to point out earlier, you could also use the candlestick patterns. So like here, if you're keen, Mathew, you'll notice that we do have a bearish rejection candle.
Yeah, sure.
Can you see that, Mathew?
Yeah. We have actually quite several rejections, and it's occurring around the
this candle.
Exactly, the resistance of the trend
line. It's an
line,
indicator of an impending bearish move in price. So you have the confluence of the trend line and the 100 EMA. And to add to that, you have a rejection candle indicating an impending downward movement in price. Then when you check on stochastic, price had actually, or prior to that, stochastic had risen in the overbought zone, and now these 2 lines were actually reversing and they were headed downwards. So this was an indication of the end of this upward move, this prior upward move. So here you could enter a sell and you'd get this nice move. Remember, this is a 4-hourly chart. So these candlesticks might seem small, but the movement is quite significant. So my entry was at 0.7134, made an exit at 0.7066. So those were 68 pips. So with this move, you could have gotten anything between 0 up to around 80 pips, 80 to 85 pips. So that is that was in early Feb, if I remember correctly. So this is a setup. So it was a sell position at 0.7134, exit at 0.7066. So if you had traded a mini, 68 pips could have yielded around $68 on that setup. And that's pretty much it. So those are the setups that we were able to identify, but there could have been more. So it just calls for one to be keen on what is happening in different charts. And over time, you will notice that these setups will manifest at some point. So I don't know whether you have anything to add, Mathew, before we conclude.
Well, from my end, I think nothing much to add, because of course, if it's a trading strategy, it's just clear cut. That's it. Maybe add a little bit into it, maybe to repeat as we're closing. It's all about using the tools you have to have the rules, or make the rules that will help you see a trade, get into it, and ride. Right. So I think the tools we're using in that case was a stochastic, and then of course you have the moving average, right? But I've seen you also combining something else. You're using a trend line, a moving average, right? And we've talked about having some candlestick patterns around that area. So what we need the traders to note is that you want to have a little bit of touch-ups on your trading strategy, add a little bit something else to add into your probability, right? Because at the end of it all, the higher the probability, the better for you. So that's it from my end. I don't have much to add, Edwin, and I think we would call it a session up to now. But also, though we had one question from a client asking about the best time frame to use. Of course, you mentioned it in between. That's why I didn't bring up the question. So, for those setups that you shared there, they are 4 hours at the 4-hour chart, right?
Yeah, basically, the whole essence of a strategy or a technique is to have a number of conditions, or what can I call them? Ideally, you have a number of rules. So you're waiting for those signals or those triggers to occur. So this is not the only strategy. You can actually formulate your own strategy. So what happens is that once you have a strategy in place, then it's a matter of retesting that over and over again. And if you take multiple trades and you notice that majority of the time, once you see those conditions or those triggers happening, most of the trades are generating profit, then you can work with that. So for this particular case, 4 hours seems to be an ideal time frame for this setup.
All right, then. I think that's what we have for now.
Yes.
All right, ladies and gentlemen, thank you so much for your time. It's been quite a clear-cut session, nothing much to try jump in and all pattern disrupt. A trading strategy just as clear as that. You have got rules, you have to follow them. All right. So thank you so much. Of course, make sure you practice. Of course, for the ones who would want to attend the physical ones, you're free to come and see us. Yeah. And of course, we'll be very happy to discuss with you one-on-one and share the tips that you can use. So thank you so much, and see you next time.
All right.
Bye
See
for now.
you until next time.
Mm.
Good night.